morning and welcome to Resilience Investor Update hosted by Nedbank. The delegation is led by the Chief Executive Officer, Des de Beer, and joining Des is Nick Hanekom, Chief Operating Officer, Monica Muller, Chief Financial Officer, and Johan Kriek, Retail Executive. The purpose of the presentation this morning is to provide a business update specifically relating to the performance over the past year as we try and navigate through COVID in 2020 into 2021. The team will also look to touch base on the outlook for the sector as well as the company at large. Before I hand over to Des, I'd like to just remind everyone to please post your questions in the chat box during the presentation, and we will attend to those at the end of Des's presentation. At this point, I will hand over to Des for the introduction. Thank you.
Thank you, Renelle. For those who don't know me, I'm Des de Beer, CEO of Resilient REIT. I'm joined by Monica Miller, our CFO, Nick Hanekom, our COO, and Johan Kriek, our Head of Retail. I'm sure most of you know the company, but in case you don't know us well, we are a very focused retail fund, not a fashionable area at the moment. We focused on non-metropolitan retail, particularly provincial capitals, also focusing on mining areas, which we see long-term future in, which has been very good for us and very defensive, and also growth suburbs, and for example the dormitory towns around Tshwane and Johannesburg, also growth areas, because with the urbanization the populations and the markets are growing. So a typical example of that is Mams Mall in Mamelodi and Soshanguve Crossing in Soshanguve. I'll thank you for the presentation. Our payout ratio of 100% has been maintained. We actually had a relatively good year in a really tough environment. 15 of our 28 malls recorded retail sales growth. We really benefited particularly from our exposure to PGM mining. We're exposed to the most profitable platinum mines. The number one is in Mokopane. The platinum mine there, it's the open cast flagship mine of Anglo Plats. I can't pronounce the mine's name, I really must learn to do so. Also Burgers Fort, which we call Dubatsi, and in Northam, which is exposed to Amandelbult, which is also a very prominent mine. As well as Brits is also exposed to the platinum area. So we have a heavy platinum area, which I think exposure, which has helped us, as has the other mining areas. Zinc, Northern Cape has done well with the zinc, iron ore, and the minerals coming out of those areas. So our upward reversions were good. The market is quite intrigued by the fact that our new tenants, our new leases were at a higher rental than our renewals. So even on renewals, we got an uplift in rental. The reason is I think that the COVID gave us some opportunity to do a bit of tenant rotation, which we probably should have done before. Some of the brands age. Our malls are not are probably very correctly sized. Some would say undersized. So the opportunity to rotate some tenants was useful. We're probably a bit softer than we should be on when it's time that a brand has reached its sell-by date, and we use this opportunity with COVID to bring in the new brands, which obviously trade at greater densities and are able to pay greater rentals. Vacancies remained low in South Africa, 2.4. We expect to go back to our traditional range, which is between 1% and 2%. And they declined in Nigeria. It's a small part of our business, but we need to mention it. I think it's 1.8% of our assets. 95% of rental and recoveries billed were collected, which we think is a good outcome. And the focus of the presentation is really going to be dealing with structural change. I think we agree with a commonly held view that 5 years worth of structural change has been compacted into 1 year. And we are grasping the nettle and dealing with a number of these changes. And I'll deal with them in more detail later. Probably the most prominent is, whether we like it or not, department stores as a concept are dead. They're not just dead in South Africa, they're dead worldwide, and we need to deal with the issue, which has numerous challenges because of the fact that the department stores are often used to anchor malls, and they're often fairly specialist sizes. The structure of the boxes is fairly specialist, and there's quite a bit of work needed in some cases to deal with those boxes. So that's the structural solutions. We'll deal with some of them. We'll show you a few plans. Loan to value ratio 33.7, which is the second highest in the last 5 years. We hope to get it for 3 of the last 5 years. Our LTVs have been sub 30. We like being in the 20s. I always blame my history of being head of loss control at Nedbank. I think I've been scarred for life and very leverage averse, and I think that's had some impact on the company as a whole. So we like lower leverage. We realise it does cost you on some of the growth in earnings, but at times like this, it keeps us in good stead. So the intention would be to slowly migrate back to comfort level. If you had to ask me the exact figure I would prefer to be 28% LTV. We also removed derivative exposure, even though in some cases they, there's a good argument for having cross-currency swaps, etc., but they are credit line heavy and they bring their own risks. They bring some hedging, but we do we take FECs for our forward income so that we can guide the market. We're not guiding at this period, but we're considering guiding in the middle of the period at some stage when we have greater clarity on where COVID's going. And also for foreign income, but not so interest protection and income. 1 year's income ahead, we cover for that, but we have no other derivative exposure. So we like dominant centres. So it might sound quite strange to be dominant in Nelspruit, but we are dominant in Nelspruit and dominant in Mafeking. We're dominant in the 2 markets in Polokwane, for example. There's the CBD market, which ironically is the more attractive of the 2. Then we own the dominant mall in Polokwane, the Mall of the North, which I think many of you would have passed on your way heading to the game farms up north. So we like dominance, and this has proved to be very good at the moment with some of the retailers cutting back the exposure. They've shrunk back into the core, and we are, in all cases, we've been beneficiaries of any consolidation of retail. So we want the principal and strongest asset in whichever market we're in, even where there is some level of competition. We retain relevance using strong development skills. One of the things that surprised me about some of the international funds is they don't have a development team. We built or substantially extended most of our malls, so we have a very strong development skills team, which is important because with structural change which we're experiencing at the moment, we need those skills. And we also, as we say, grasp the nettle. We proactively address structural change. I think we're alone in the industry as being as proactive in dealing with the structural changes that we're facing at the moment. And conservative risk management, it's not new. We've been through some tough times. We came under attack from short sellers, and I don't know what the expected outcome was, but our conservative leverage levels and exposure to other risks, we maintain as conservative a position as we can. Comparative retail sales. So our worst performing mall was actually probably one of our most beautiful malls. That's Ilanga Mall, which is the dominant mall in Nelspruit and the environs. The reason that it's battled is because Mozambique border was closed for, I think, over 2 months. So that's basically a huge chunk of our turnover is completely gone. That border's back open, and we expect it to show a strong recovery. Even through this very difficult period, a number of retailers chose to cut their exposure to different offerings in the immediate vicinity and consolidate it into Ilanga. So even though the actual sales were very negative by 11%, we benefited from consolidation into the mall, which bodes well for the future. Livonia Village, We should have been. It's a convenience centre. We have a swarm of motorbikes around us. It's like being in the middle of a swarm of mosquitoes. However, our immediate market, we have a reliance on office employees, and the office employees are overwhelmingly at home. And the residential areas around us, which tend to be mid to high LSM groups, also stayed away and used the online mosquitoes to supply them. So it was quite disappointing that Rivonia was so severely affected. But it is a common theme. Again, the Grove, similar story. Jabulani, we were busy with, we should have done well, but we were busy with some construction. We cut the Edgar's store and we added Dis-Chems, so there was quite a bit of building happening at the time. And so we've actually dealt with the Edgar's issue there. We like the new size of the Edgar's store, but very disruptive. We also think it needs another grocer, but I'll show you a bit later what we're planning there. Irene, very typical. Metropolitan markets, very severely affected, 9% down. Everything wrong with it. Higher LSM residential area, metropolitan and high upper middle LSM income area, been very, the worst affected. Highveld Mall, we've got access and issues there, and we also need another anchor there. We need another grocery anchor. It's anchored by Pick n Pay, and we actually need 2 grocery anchors, and we're losing some market share to a convenience centre up the road, and we intend to remedy that by adding Checkers. Checkers are keen to enter the centre, which we think will remedy that position. And then Galleria didn't have, unfortunately, there's some, we do benefit from the holiday season, and we lost the holiday season clientele, which negatively affected us. And I think that's a common problem with most of the coastal areas. I'll just deal with the most the extreme, the 5 from the top and the bottom. The Harbour Crossing, which is really next to Galleria, benefited from us adding new additional letting in. We took the small food lovers and turned it into a major food lovers. We increased the size of many of the other offerings, and I think it was a category, because it's a value centre, it was a category that tended to do very well when people didn't want to go into malls. You can park outside and pop into the directly into the shop and run away again, because people have been very sensitive for good reason about COVID, and I think they benefited from that. In Vudzulutsu in Limpopo, we really doing extremely well. What happened is the Pick n Pay store there, which really was the wrong brand for that market, was replaced by a Boxer store, which operates at a low price point. The turnover doubled immediately, and then so they both belong to the same group. But the market really liked the Boxer store. It was correct for that centre, and it also all the other retailers benefited from the stronger performing grocery anchor. Tubatsi Crossing, I mean, this is just a fantastic area. This sits on the eastern limb of the igneous complex. That's the big open cast mine on the UG2 reef. So it's essentially a palladium producing area. It's probably the richest mineralized deposit we have in South Africa. Huge chrome deposits, etc. We really are quite blessed as a country, and this sits right in the middle of it. So fantastic positioned mall in an area that will continue to grow strongly ahead. There's a lot more of investment into the area, generally known as Burgersfort. Most of you will know it as that. Northern Plaza, again, exposed to a Mondelbult, which I think I might have mentioned. Mokopane, flagship Anglo-American platinum mine, open cast, even better. And Northern Diamond Pavilion, obviously Northern Cape, which is so we benefited strongly from the exposure to the mining, and mining tends to be very cyclical. I'm loving hearing the CEO of Impala Platts saying that we're safe for the next 5 years with the PGM basket. I hope he's correct, but I think there's a high level of conviction there. So we overwhelmingly corporate tenanted. Some people would call us a bit cookie cutter and a bit dull. So we don't have the enormously original boutiques, although we do welcome new brands and interesting brands and follow the trends very, very closely. So overwhelmingly corporate. Foschini Group, which has now increased because of its acquisition of Jet. So all the new leases were signed with for the Jet stores of Foschini, which we're happy with. So it's a good covenant. Pepkor, Mr. Price, Shoprite, Checkers. This is as gross rentals. On GLA, Shoprite Checkers is our largest landlord and a target for our markets, a target tenant. Massmart, you'd expect, we can pay Truworths retailability. This is a fairly high-risk tenant. This is owns two businesses, so it owns the legit Beaver Canoe business and Style, which you may know this. So it's got a private equity structure, which is obviously not a great covenant. And they bought the Edgar's business. So that's with a private equity structure and the history of Edgar's, I would accept that is there's still some risk in that. Woolworths, Studio 88, which is the leader in athleisure, the leading retailer in athleisure, completely. It's obviously its competitor sports scene from the Foschini Group, but a very good category and trading extremely well. Clicks, ABSA, FirstRand, Standard Bank, Nedbank, Capitec, and Discom as well. So nothing terribly exciting, but we do sleep well with our tenant profile. I think these tenants alone are 60% of our total rentals, and we historically were 80% corporate GLA. I think we're probably 70 now. So, but a very, as I say, maybe considered a little bit dull and cookie cutter, but we do sleep well on this profile. Big changes in the environment. I think what differentiates us from our peers is that we're dealing with the issues. The decline of department stores, I think, is probably putting it mildly. I think it's been a collapse of department stores, and we've dealt with it aggressively everywhere. The fact that we've got a new tenant with retailability is not really the solution. The store sizes that they're looking for, they're saying 6,500 square meters. We're signing them, but we really only want them in the store sizes of 2,000 to 4,500. We understand their store layouts. We want them in generic boxes so that there's no specialized department store boxes left in our centres, with the exception of Woolworths. And we understand which are the international brands, their designs, the team. We spent a lot of time with the CEO. We've completely very competent, capable guy, but obviously something that needs looking at. We'll watch it closely. Retailers have changed. They've improved their logistics, and they're using retail space more efficiently because they can resupply more efficiently, which is having some impact. Demographics with resulting changes in brand preferences. Different groups and different income levels have different preferences, and we need to react to that, which we've done quite aggressively. One of the attractions of the Grove Mall is it's essentially been a sort of a suburban mall focused on the Pretoria East market. It has the fortunate benefit of being very close to Mamelodi, particularly the southern end of Mamelodi, with this affluent housing coming in. Very attractive market for us. So we're immediately metamorphosing to attract that market into our mall as well. Things have been tough, so even though there's more money around, there's definitely an increased spend on groceries. So part of the and also we're seeing almost a hardening of consumer preferences to certain grocers. So we need to give them the full offering. But some of our grocery stores have been over trading to levels that are really not pleasant, particularly in an environment where we need some element of social distancing. And so we're looking to add 8 REIT grocery stores. Some of them are completely new builds, just to correctly position ourselves where the market is. Generally, they're Shoprite, Checkers, or Spar, which is more suitable for our market. And we, in all cases, end up with new 10-year leases. Again, good for our strength of covenants, etc. Consumers are demanding more convenience. The old days when you used to put them in one of the mall and force them through a tunnel all the way to the east, that sort of concept is very dead. So the modern malls like Mum's Mall, where you have 4 entrances, they've got a short lead-in mall. They can shop close to the distance to their target shop is manageable and not inconvenient. So there's a respect for the convenience aspect. People don't have time and they're not really interested in walking half a kilometre to get to their target shop. Once they're in the mall, we hope that we can lead them astray with some tempting other offerings, but it's not. But they know that if they need to get in and out, they can. So it broadens our market appeal. Edgar's I've mentioned, so we see it as we like the new model. I mentioned the 2.5 to 4.5 and the 8 grocery anchors, and we're working on improving accessibility. We spent a lot of money. Johan, for the equity investors, discussed how we put in a 8 million rand ramp on at Ilanga to make sure that the traffic from that portion of town could access just as easily as from the other areas, and had an immediate positive impact on Woolworths. So I can't remember what was 12% up immediately in the first year. Yeah, so with this convenience aspect, we must be very mindful of. This is an example of some of the changes we have here. This is Circus Triangle. So just to show you the size of the Edgar's box here. I'll try and be quick with this. You can see the demand for this tenants. Clicks moved out. The Tiny's going to move out their store there. They need to double. Sports Scene, Foschini Group, a whole lot of brands that we were missing. Ackerman's Woman, which we'll speak about later. Also, the chicken OBC, which is a butchery, but it's really a small grocery store. So what we're looking to achieve is underneath this section is a taxi rank. So that's a taxi rank as well. So basically the mall becomes the thoroughfare between taxi ranks. At the bottom of this section here, there's a ShopRite. And then we wanted the OBC, which really complements the ShopRite store as well. So very, very dominant position from and running between the 2 taxi ranks, we found a very good model because there's long distance, short distance taxis, and they go in different directions. So you can see about the tenant demand, but you can see also that so that leads to the taxi rank. This was all the big Edgar's box here. So quite a bit of construction solution to that. I'll try and be quick with this. Here is the Grove. So at the bottom level here, we have under the Edgar's, we have a Pick and Pay store. On this level, we're adding a Checkers store. We really want both in this market, and the intention is to cut this Edgar's by half. I can't say more, but clearly with the Checkers next door, the demand for this space is considerably increased, and the intention is to put a builder's supply company. I just can't mention much more than that. But that will cut that exposure in half and also strengthen the mall. So this is the entertainment and value element. The Mr. Price Home does fantastic figures, and underneath it is the entertainment element. And then on both levels, we'll have anchor grocers, which is a strong model. And this is Jabulani. We sit with a very strong ShopRite, completely over trading. Food Lovers completely over trading. But we want another grocer, the best grocer in Soweto. Most people who know Soweto will know the Pick and Pay store in Protea North, which we're very jealous of. It's run by a local franchisee, fantastic store. We've agreed with Pick and Pay that they can have that box, which of course they'd love to have, on condition we have that franchisee, and that's the change there. What we've done here, the Edgar's solution here was in fact the Dis-Chem, so the Edgar's is already halved, well, not quite halved, and we've had some cutout boxes as well. So a lot of these stores have already been sorted out and aren't included in our 9 store solution, the current 9 stores. Here again, this is Mum's Mall. You can see we've got a Pick and Pay here and a ShopRite, and in the middle of it, so the Mum's Mall is overwhelmingly the grocers trade extremely well. There's even on the taxi centre there's a little Boxer store, but I wouldn't call that a full grocer. So the missing element here with a strong brand following is Spar. So we're going to add Spar in there, and that sorts out the that box as well. The ShopRite particularly is over trading to the point of being an unpleasant shopping experience. Here again, we've got this is Mvuzulutsu in Toando, Boxer on the one side, double anchored. We're introducing Spa on this side. We're doing fantastic figures out of this Boxer. This is the store where we swapped it for the Pick and Pay for the Boxer, and the turnover went through the roof. There's more market share there, hence, and Spa is really very powerful in this market. So we're quite excited about that. What we managed to do, which Jet weren't keen on, so the Edgars has exited, and that will be the Spa. We've managed to squeeze a bit of space out of Jet, which Foschini weren't keen on. They wanted all the space, but we really needed the clicks, and we managed to squeeze the clicks in there. These are some of the brands. There's a lot of rollout. The rollout of many brands, and we've mentioned some of them. Some of them quite surprise us. So despite COVID, the retailers have been busy, but they've been very, very focused. Some of the brands surprised us. We wouldn't understand why it would be necessary to have a separate Ackermans for women. Pepco worked out that there was a separate market that didn't like shopping in the generic store, and it's been a runaway success. Bogart will speak about, Drip, Fashion Fusion, Legends Barber will speak about, Refinery, Batu, Code, which is Pepco. Some of these are national brands. LS, which is part of Studio 8, Gridline, Polo, which has been around for, belongs to the Surtee family, it's been around for, I don't know, 100 years. Studio 88 and Webbers, these are the, so I'll run through them. There's Ackermans Women, they're rolling it out steadily, obviously very targeted markets, but really trading well, and their strategy's working well. Batu, this is a local South African entrepreneur that came up with this brand, which has become very, very powerful, obviously, and particularly in certain markets. It's an expensive product, aspirational product, beautiful shops, and trading really well. So we're wary to roll it out too rapidly, but it's really nice to get homegrown success stories, and this is one of them. Very, very trendy and very aspirational. This is Bogart Man. The business has been around for some time as well. They're using this opportunity to gain space where they would not have had access to previously. Also very aspirational and really attractive shops. Code, this was a sole proprietor. Pepco was proving to be quite surprising us. So this business was privately owned, was bought by Pepco, part of the Pepco chain. What they liked about it is it wasn't branded products. So they sold John Craig, you may be aware, to Studio 88, and they bought this, which is unbranded, trendy but unbranded products, which is exactly their model. So they're very disciplined about it, and yet I think this is a good choice of theirs. And so this is actually Pepco, which most people wouldn't think would be Pepco. Drip, this is in the Mall of the North, and I'll show you the shop. Also very, very trendy, very successful, doing great figures, gaining market share, very selective where they want to be. You can see the sort of location they're sitting in here, really a good location over from Foschini's on the other side. So in the fashion mall, this is the shop inside, and we're very happy with it. Limited rollout, very focused. As you can see, I'm taking too long here. LS, international brand owned by Studio 88, which is probably, as I said, the dominant athleisure business in South Africa at the moment. They're pulling it out of their Studio 88 and Skipper Bar stores and setting up standalone stores because it's such a successful brand. Fashion Fusion, it's a value fashion product. Limited rollout, but use this period also to gain space where there were opportunities and trading well. So a value fashion offering. Gridline, this is branded products, again, a nice addition to the mall. Also some rollout, limited rollout. They run these businesses very carefully, but you can see the brands that they have access to. I think I'm taking too long here. Legends Barbershop, won't spend too much time on it. Also permanent queues at that shop. Polo, been around forever, I mentioned, the Surtee family. Refinery, Pepco, rolling them out at the moment. I think they're rolling them out in the general market, but focusing on our target markets. Studio 88, which I mentioned, Bielli has been around for some time. Have used the opportunity to open a few more stores, but very focused as well, very high-end and aspirational as well. Good. I can see Nick's busy moving me on here quickly, so I'm rushing a little bit suddenly. This is extension to Mafeking. We've waited 10 years, I think, for the rezoning here, over trading. This is the capital Northwest Province. A few changes, so we've got strong tenant demand. This at the moment is a Checkers. We'll convert it to a ShopRite. We're opening an access point here. The taxi rank, by the way, sits over here, not right here, but just about over here. So we've got access to the taxi rank. North of this, we had to cut off. You can see some of the parking, and the main road between Mbatu and Mafeking is over here. Adding in Checkers, a number of brands that were missing, really just very tenant driven. Eventually, we could add an extra section here, but we're happy just to do an extension just to take care of the existing demand for this for space, which has been there. This is land that we've owned for some time. We want to monetize it, so we've let it to Checkers and one other grocer, which you can imagine who it is, but we haven't signed the deal, so we can't say it is. Clicks and a few other sort of convenience offerings. We'll probably sell them all, because with that sort of 2 10-year leases, with corporate tenants anchoring it, it's really not a hard sell, but it's really not our target, and we don't particularly like Clarkstorp. We want to be in the growing mining areas, not the sort of declining mining areas. Solar rollout, to give you some idea of what's happening here. I'll be very quick. You can see the yields are attractive. This here, why it's got a white roof, is we wanted additional space. The roof couldn't handle the weight of the solar. We also didn't like underneath it is parking. We didn't like the column line, so we actually replaced the roof and gave us more space for solar. We're very excited by the Minister's announcement that increasing the amount of solar that non-licensed providers can produce, because at the moment I think we're reaching 9% of total consumption. We think we can easily get to 20 and do so at an accretive price. This is really where all the excitement is, which you might have seen before. It's about peak shaving. So it's about taking the load when we've got excess load and actually putting it into the batteries. That model now works, and discharging it at this point here just to drop up our maximum demand levels. So there's some really exciting things ahead. The battery model now does work. We just haven't got the rights at the moment to get to the megawatt capacity we need really to use it properly. But we're ready for it, and we're waiting with bated breath for the Minister to promulgate the changes. This is Nigeria. So the big problem with Nigeria is access to currency. I think it's benefiting from the oil price, so we're trading a lot better. Cinemas are limited to 50% occupancy. Most of the remaining vacancy is actually earmarked for cinema expansion. Nollywood movies, as you know, are a great hit, but the problem is access to foreign currency. There's limitations on that, which is proving to be a problem. Fortunately, our exposure to Nigeria is 1.8% of assets, and I wish it was not even that. We just started the Nigerian soap opera with, as are a number of other South African corporates. Listed portfolio. The market wants us to hold on to investments where we have significant influence. I think it's a nice way to put it. So we have reduced our Napier Rock Castle holding, and we've increased our Lighthouse holding, which we do have, which Resilient effectively has a controlling interest in. And we will continue. We actually, the market's quite nervous of us selling Napier because it's putting there's a perceived overhang. So we'll probably do a big bang deal and with one of the big institutions that's approached us and exit the entire position or most of their position in one go. We love the business. It's a great business. It's been very well managed. It's in some of the best markets in the world. But we're just really passive shareholders there, which is not our business model, and it's also not what our investors want to see us doing. They want us adding value. So financial performance. Do I hand over?
Thank you, Des. So we can just talk to some of the key ratios. I just want to quickly mention why we still provide management account information. The SA REIT ratios are in terms of the SA REIT best practice recommendations and are done so that there's a level of comparability between the market. They are, however, IFRS based. We still produce management account ratios. That is, our management accounts look through to our interests in Resilient Africa and Mahi King and Arbertown, which is one of our subsidiaries, and it also fair values our investment in Lighthouse. So just to talk to the net asset value per share, the major difference there between management account ratios and the SA REIT ratios is because in the SA REIT calculation, we adjust the net asset value by the dividend that we've just declared. This, however, doesn't take into account rentals that you earn between the 31st of December and the date in which you pay your dividend, and it also doesn't take into account the dividend which we would or have already received from our investments in Nepi Rockcastle. The net asset value on a SA REIT basis was also adjusted for our deferred tax liability, and the denominator is adjusted for dilutive instruments, which in our case at December 2020 includes our LTI award, which vests in September 2023. If we move on then to the next slide, this basically talks to the uptick in the gross property expense ratio, which is mainly as a result of the effect of COVID. So you'll see that in the interim period, we've provided another 43.7 million in discounts, and this is mainly to leisure and entertainment focused tenants. And the tenant arrears is also increased by a further 20.5 million. This is also largely because of leisure and entertainment focused tenants, and is mainly as caused by the effect of the varying restrictions that have been placed on their trading during the lockdown period. You'll also know that Ster-Kinekor is currently in business rescue, which has also contributed to the tenant arrears written off. And as the business rescue process with EdCon comes to a conclusion, we've had to write off an additional 2 months of utilities which were billed during the business rescue process, but actually related to consumption prior to the business rescue being initiated. Tenant arrears at December 20 was 65.2 million. Of that, 15.2 was received at the time that we, or collected at the time that we had released our results, and 14.3 million of that balance is also expected to be recoverable on conclusion of the business rescue process of EdCon. Adjusting for these two items, our tenant arrears comes in line with our December 2019 levels. Look at our facility profile, relatively consistent with that of June 2020, with the exception that we've increased our exposure to Nedbank with a new 3-year facility of 113 million and a new 4-year facility of 300 million. If we then take a look at our facility expiries, you'll see a large chunk of Standard Bank debt, which is due in the 2022 financial year. We've received credit approval from Standard Bank for the extension of these facilities, so that process is well underway. We've recently extended 1.85 billion of facilities with RMB for until July 2022. This is just to give us some flexibility pending the outcome of the PIC discussions. If that transaction does not proceed, we will renegotiate these facilities for a tenure of 2 to 4 years. And just to talk to our funding strategy, our policy is not to borrow against listed securities. We do, however, have 450 million rand approved on this basis. The facilities are unutilized and are just in place to provide us with a level of flexibility. Our unbonded investment property, excluding land at this point, is 1.8 billion rand. It is our strategy to increase this to approximately 50% of our SA portfolio. We would like to increase our flexibility to accommodate a potential PIC transaction, which is hopefully going to be concluded within the next 4 months. Over the past 5 years, our LTV range, or the range of our LTV ratio, has been between 21% and 34.8%. We would like to still target a range of between 25% and 35%. We are currently at 33.7%, so more on the higher end of that, and will hopefully come below 30% with the PRC transaction. Thank you, Dave.
Great. So just to add to that, the banks tell us that we're one of 3 target clients. Maybe they say that to everyone, which is comforting, and the banks have been very, very supportive. We have in the past limited our exposure to the DMTN market simply because of the cliff events. We've had good support. As you know, last year we issued 2 bonds, and we've been the market's been very supportive to us, but in the back of our mind, we're always concerned about what happens at the end of the period. So you actually need bank backup facilities. So that has been a nagging concern in the back. We sold Merchants Mall to the Community Growth Community Property Fund. It hasn't transferred, but the deal is conditional only on ComCom. I think you're aware that we signed an engagement letter with the PRC on behalf of the Government Employed Pension Fund to negotiate the sale and purchase of interests in the following properties, 2 of which we will end up going into partnership with them. We didn't approach the PRC. They were very proactive. They went around and looked at all malls around the country, and they approached us and said, we'd like the following malls, which we nearly fell over because we didn't know they'd even been there. Obviously, our centre managers weren't very alert. We weren't happy with their selection, and we've sort of reached a compromise. But there's a lot of water still to flow under the bridge. For example, they wanted 100% of Kabatsi crossing, so we've compromised with them. The attraction of the PRC is not that we need money. The attraction with them is in a capital deficient market. We think they're very attractive partners. They want us to do all the asset management, and so that's a very hands-off approach because we know they're very structured and lots of procedures, etc., which we don't want to be dragged into. But they, in fact, their preference is that we take on asset management for 5 years, but we would prefer 3 years at this stage, and obviously to be looked at again. But we like the people, and we like the association with the PRC. And it's very flattering to have been approached after their search for our properties. We expect them to approach at least one other landlord but I'm not sure what their plans are. Challenges, excuse me. Going ahead, economic policy uncertainty. Administrative prices is a continual nightmare, and it's very tenants operate on cost of occupancy. And if the parastatals keep consuming a portion of it and we're not growing fast enough, we're at risk of losing some of the income. At the moment, over an extended period, our malls have been growing strongly, so it's sort of absorbed some of this administrative pricing, but it is a continual concern. Deteriorating infrastructure is a big concern. The leisure and entertainment, so it's only 5% of our rentals in normal times. At the moment, it's almost 0% of our rentals, and we're not sure where the future is. We've done a lot of work on what the Chinese experience is, and we're expecting big structural change there. So this experience in China is close to previous attendance levels, but the big disruptor has been the growth of the what's it called, the IMAX. The IMAX has taken off there. So IMAX has moved from being a wonderful experience looking at mountains and rivers, etc., into the blockbuster movies being produced on an IMAX format, which obviously is a very, very, very different experience. We only have one IMAX theatre, and they're very expensive to put in, so we're looking at this with great trepidation. Also staying abreast of structural changes. We do think that we are very, very proactive in dealing with them. So you can see we've really dealt with the Edgars aggressively, and we work closely with management, with the new management. In some cases, we've taken stores away from them while they were in business rescue, which they were very sad about and would rather have had those exposures. But they've honoured those deals. I mean, those deals were done with the business rescue level. But obviously, but we're dealing with it as sufficiently as possible. And whatever the outcome is with the future of cinemas, we'll also we'll grasp it and deal with it and do whatever is necessary. Outlook, we've had for many years a conservative financial structure. We're a little higher than we normally are. And as I say, we'd prefer to be back in the high 20s LTVs. And our preference is to increase our stakes in existing investments, which we know and which we actually manage anyway. We haven't provided guidance for second half of 2021, simply because of COVID, which is convenient in some respects. But as soon as we have greater clarity, mid-year, mid-period, we may even come out with guidance, particularly on the South African portfolio, maybe not on the investments. Q&A. Great.
Perfect. Thank you, Des. I see there's a few questions that have been posted. We'll try to address some of these. If we're unable to answer some of the questions, the team will endeavour to provide written responses to it. So if I can start, there's a question from Khaliso at Coronation. How will the proceeds from the PIC be used?
I think the primary objective would be to buy out existing partners. We've got some great partners, but they're great assets as well. We've got Sasol Pension Fund in Secunda. They may be prepared to sell. Mumps Mall, we really like Mumps Mall. We have a partner there. In fact, many of our malls, we have partners for historical reasons. In many cases, they're BE partners, which we particularly don't want to buy out, but we might buy a portion of their shareholdings. But better, we know those malls well, and it will actually be more efficient for us to own a bigger share of those malls. So we are looking at other opportunities, so options, etc. And they may be international, they may not be. We'll probably replace the NEPI investment with an international investment, and the South African sale with South African assets. But we're not really looking at new investments. The market has changed considerably. So the extensions and new developments are the exception rather than the rule. But there's quite a bit to be done just with our existing partners. One of our partners owns a mall in Acorn Hook. We like the area, we love the mall. So there are other opportunities out there. They're very keen to have us as partners because they've worked out that you need scale when you're in the retail business, because otherwise the retailers are very aggressive and bully you. So suddenly we become a lot more attractive to our partners, and particularly where we're not included in assets that partners own. And Acorn Hook is an example.
Sure, thanks. A follow-up question from Khaliso is, and I think you've answered this, where will the NEPI proceeds be directed?
I think it probably redirected in offshore investments, but not necessarily. We don't mind to drop our leverage, which obviously is yield for periods of time. We are looking at a lot of investments, and there's a minefield out there, and there's risk everywhere. We've been very daring through Lighthouse to be invested in Hammerson. We were fortunate there, which the market didn't understand, is that we had, this is why we like the PIC. So in Hammerson, we have a PIC, which is the Dutch Sovereign Pension Fund. I don't think the market fully understood the messaging, which they've been completely consistent about, is that they fully support Hammerson and will continue to do so. So that's why we like these big brother relationships. When we're not that big, having a very big brother is very helpful. So we would look at alternative investments overseas, but if we need to, we'll invest locally. And another alternative is to return capital. We're trading below NAV. If we need to return capital, we'll do so. So we're not going to force decisions. We're not going to enter into markets we don't have a very good understanding about, and we're not going to enter into markets where we don't have scale. So we're very, and there's nothing wrong with handing back. Nothing wrong with handing back capital. We're still trading at a discount to NAV, and handing it back could be a solution. Good.
Perfect. Thanks, Des. Another question just being posed regarding the potential disposal of assets to PIC. Please, can you provide more clarity as to why you would look to dispose these assets? And if the transaction is to go ahead, what would you use the proceeds of disposal for? Direct offshore properties or more listed investments?
I think we've largely answered that. The biggest attraction of the PRC deal is the partnership with the PRC. We won't lose scale because they've made it a condition that we asset manage those assets. So we keep scale, and yet we get a partnership with probably the most desirable partner, probably the most bureaucratic and time-consuming partner, but probably the most desirable partner in South Africa, particularly from a capital perspective. So I think that's some of the assets we don't really like going forward. Mthatha, you can see that's the asset we showed you with all the tenants cramming into the new space. The problem with it is the next closest mall to Mthatha is 500 kilometers away, so it's not efficient for us to manage it. But in terms of the deal, we'll have to asset manage it for at least the next 3 years. It's also the reason why we sold Murchison Mall in Ladysmith, so the similar thinking there. But other than that, I think the intention is for this to be a long-term partnership. And we're quite flattered that they found us attractive partners.
We have a question from Antoinette from Future Growth. What portion of new leases are signed on turnover-based rental format?
Almost none, in fact. I think the cinemas would be based on a turnover. That's because they're in a state of, but we don't sign turnover leases generally, and we're not changing that format. It's just not attractive to us. Tenants would like it because it gives them more flexibility, but it's not attractive to us. You know, they get a great. They're running very profitable businesses out of our stores. What we want in exchange is a fixed rental, an escalating rental with upside for us, a turnover clause. But we know that we keep our rentals at respectable levels. We're not over-rented, as you can see by our experience through COVID. But turnover rentals are not attractive to us at all.
Moving on to a question posed by Mornay Visser. Are you confident that a cookie cutter approach situation will be sustainable in an ever-changing and demanding retail environment?
We change our tenant profile. In fact, we've used COVID to change the tenant profile quite aggressively, and we'll continue to do that. But we do our target clients, particularly in the where we focused. They're very brand conscious. They're brands that work, and they're brands that don't work. So we're quick to introduce new brands that do enter the market, but we're not adventurous, and we really want decent covenants as well. We go back to new guys, but that's what our client base wants. Very brand conscious and very brand loyal. So which you can see through the retailer's performance. Good.
Perfect. We still have a few minutes. We've got a question from Kapano at Mazi, Lighthouse/Homerson. Are you confident of a revival in UK retail given the structural changes?
So I think the disruption there is considerably greater than what we've experienced. I think it's probably similar to what the metropolitan regional malls have had. So they're sitting with department stores, and I know there's people who argue that there's a future for John Lewis. I think the department store model is dead. They've got leverage issues, they've got liquidity issues, etc. These are all manageable. They've got proper support. And then almost the entire board has changed. The entire management team has changed. A private equity CEO has been brought in. We like the private equity CEO simply because the one thing private equity is good at is structure and efficiencies. So, I mean, the business will be considerably transformed. Obviously, the leverage needs to be dealt with. I won't say too much about that, but all this is all work in progress. And the nice thing is that we have a big daddy partner there with which we've got a very good relationship. We speak to them fairly regularly, and they're very committed to support the business. And if you look at it, even on a distressed basis, the valuations are very, very extreme. So I think we've done very, very severe modelling on it, and it needs a lot of capex. We don't like the way their malls are run through. They're old-fashioned malls. There's a lot wrong with it. But on the other hand, their positioning, unlike Into and I won't mention the other company, are centre city. You can see even in Leicester, we've mentioned Leicester's probably the least favourite mall, And the Debenhams get sold, the land for the Debenhams you make money on turning into a block of flats. I mean, so there's their locations are fantastic. That's why we always liked them, and we never liked Into. Into's malls are generally motorised destinations, not centre city locations. They're very different.
Perfect. Thank you, Des. There are still a few questions that we will provide written responses to, but I think for now we would just like to thank everyone for making time to attend the session. We do appreciate the engagements, and at this point we'd like to say take care and stay safe, and till we chat again, goodbye.
Thank you. Thanks everyone. Thank you for your time.